Hi, this is Mike Wise at Capstone Direct Mortgage, and today I'm going to go over a product called the All-in-One Mortgage. Again, this is Mike Wise. I work for Capstone Direct Mortgage, and I'm powered by CMG Home Loans. And this is an exciting product that I actually want to talk to you today. It's a lot different than the 30-year fixed rate mortgage, but you are going to see some powerful things here a little bit later in the presentation. So this loan, it's a principal first loan rather than your 30-year fixed rate mortgage, which is interest first. It's a principal first mortgage. It's going to save you thousands in interest, maybe even hundreds of thousands of dollars in interest. And you still have access to your money 24/7, 365 days of the year. So we're trying to get you to a point of greater financial independence by owning your house a little bit faster. So let me just talk first and give you a little bit of background on how we do this. So mortgages, they actually play a significant role in the housing market, and people need mortgages to finance their home. Most people do not have cash to finance their home. In fact, in 2022, probably 16% of people paid cash for their house, which is, a good percentage, but 84% of the people financed a house. They needed some type of financing to buy that house, and 62% of Americans actually own a mortgage today. But it comes at a cost to buy those houses, and we're dependent on outside influences like interest rates that play an important role. And basically, as interest rates move up, that slows down the housing market. And as interest rates go down, it basically accelerates the debt levels. It accelerates the need for financing, and more people go out and buy houses. So we are driven by that. And most of the time we are, looking at a 30-year fixed rate because that is the commodity, that is the program that we use. And I'll go into that a little bit further here in just a second. So basically, the impact on the financial security or independence of home ownership is basically during one of the most costliest periods of your life. And what people do is basically they use the 30-year fixed or a longer term to minimize your payment so you don't have that high payment during the costliest periods of your life with kids, college, marriages. I mean, all those things that come into play, we do that. And 90% of the population of the United States uses a 30-year fixed rate mortgage to repay their loan. And that it takes a long time to do that, and it's very, very expensive because it is an interest first mortgage. Over the first 15 years of the mortgage, you're paying more interest than you are principal, and it gets super expensive because that interest is charged up front on this particular amortization, the way that the 30-year fixed rate works. And you know what? The total mortgage debt in the United States is actually $12.2 trillion. So it's a huge, huge piece of the market, of the economy. And basically about half of all households will not have enough money at retirement and to kind of like maintain their standard of living. So it's really important for us to actually gain that financial independence and security of owning your house sooner rather than later. So 70% of all debt, it goes towards your mortgage. So that's it's a huge piece of the economy. And this is what most people have a mortgage. And so this is where most of their debt is going towards, is that mortgage payment. In fact, 42% of their actual income is going towards that debt. So if you, whatever your gross income is, 45%, in some areas it's even going to be more, goes towards paying for your mortgage and your housing to pay off that loan. So it's all the rest of it goes to the other, cars and credit cards, utilities, all that type of stuff. But 42%, it's a huge piece of your monthly budget. In fact, most of it again goes to the interest, and so a huge piece of that that you're paying during that first at least 10 years is going towards interest. So much of that is being charged up front in interest, and we want to take care of that so that you pay less interest and more towards principal, and it's not a shorter term, and it's not going to change the way that you live on a day-to-day basis. The 30-year fixed rate mortgage, it has some pros, it has some cons, and let me just go through just a quick summary of all these things. 30-year fix allows for a low down payment, so you can do 3% down, 5% down. That's great. It's very familiar to everybody. So it's been around since the 1930s. And it was your grandma, grandpa's loans, your grandparents' loans, it was your dad, mom and dad's loans. And now it's coming back, or it's still here in 2023. And you have that familiar, that's what I'm going to get. I'm going to get a 30-year fixed rate mortgage. It's readily available, or a commodity in our world of financing for a house. So you actually can have you can go to a lot of different places and get a 30-year fixed rate loan anywhere. Is very, very much a commodity, and it's payment dependable. So basically, you're going to have that same payment for 30 years if you want to, and you won't have to worry about that mortgage payment. Super nice to have. At the end of the day, though, most people only have their mortgages for 7 years, and then they refinance or sell their house or do something that gets rid of that loan, and then they start the 30-year process over again, which is the most expensive process. So again, that brings me to the cons. It's basically it takes a long time to pay off that mortgage. It's very inefficient because the costs are paid primarily first with the repayment schedule of interest. And also, when you put money into your mortgage, if you pay down your principal, you got a bonus and you wanted to pay down that principal, good job, that's awesome. But at the end of the day, you cannot get that money. It's buried in your mortgage, and you can't get that money until you sell your house or do some type of refinance to take money out of your house or a line of credit. And then it's just super expensive. Even with low interest rates, it is super expensive to have a 30-year fixed rate mortgage because of that interest. So let me give you an example of that. The 6% on a 30-year fixed rate loan of $640,000, it's basically going to cost you $1.3 million in payments. So over $1.3 million goes to payments. That's 73% more than the value of your house that you purchased. And $741,000 is interest dollars. So for every $100,000 that you're borrowing, you pay the bank $16,000. That's 116% of interest versus principal. So you're paying a lot of interest to have this loan. In fact, let's lower it down. A lot of people have a low interest rate mortgage right now, and it's at 3%. So we did the same thing. You're still paying $331,000 of interest, $971,000 of payments, or 22% more than the value of your house. And 52% of this is interest versus principal. So I want you to really think about that. 52% is interest versus principal. And this is shown in the amortization schedule here that I'm showing you here. And basically the orange line is the interest, or orange lines is the interest. And that's the first 15 years or more, 17 years of your loan goes to the interest. So you're going to pay way more interest up front. And then once you get to year 18, 19, 20, all the way through 30, then you're starting to pay more principal. So the goal is that you pay this mortgage off over a long period of time, but think about all this interest that you're actually paying up front to service this loan. And sometimes you refinance and start that 30-year fixed rate period over all again. And that's, again, the most expensive part. You cannot take money out. It only flows into the mortgage. So this is another piece. This is the rigid piece of this 30-year fixed rate mortgage. You cannot take money out of it unless you refinance or add a second mortgage, and that becomes more and more expensive to do over time. So the way we look at this is that there's three things that make up a mortgage, and this is the rate, the time, and the principal. So each one of those, as they go up or down, will determine your mortgage payment. And the higher the rate, the shorter the time, and the higher the principal balance, the higher your payment's going to be. If we can basically take a lower principal or a longer period of time, that's going to lower your payment down. So all of the three of these factors have an impact on your mortgage payment. Now, what we're going to try and do here is actually take the rate and move it out of the equation. So what we want to do is only focus on your principal and the time of your ability to pay that mortgage back. So we want to limit that time and pay down the principal faster, and basically not have the rate be an issue on your loan. So the opportunity here is really, really big. In fact, we want you, instead of paying more interest, remember the one slide, a few slides back where it was all that interest that you were paying? We want you to actually start saving more money for your retirement and having that money readily available to you at a later or earlier, much earlier in life than on a 30-year fixed rate mortgage and paying that loan over time. So what we have, it's called the all-in-one loan. So this all-in-one loan, it's a very, very cool loan. It accelerates the payoff or pay down of your principal. It lowers your monthly lifetime and interest without changing your budget whatsoever and without depending on lower interest rates or lower rates. And it also provides 24/7, 365-day access to the equity in your house without refinancing. So we give you the peace of mind that's in your house rather than just interest rate. This product allows you to do so much more and actually charge you a lot less or incur a lot less interest payments on your loan. So let me give you a little bit of an example here. The all-in-one loan. Let's get to the next slide. The all-in-one loan, it is a mortgage, and what we do is we take, instead of it just being a deed on your house and only having a loan on your house, we combine that with your personal banking. Okay, and so what we do is we try to combine those two together into your mortgage, and you still have access to ATMs, personal checks, online banking, mobile banking, client services, everything. It's a FDIC insured money. It is the same fraud security that you have on your current bank account or checking account. It still has all of those features available. So what we're going to do is we're going to take those together, and we're going to try and focus on your net worth. So we feel like your checking account is the spot where all of your net worth goes into. And in fact, in 5 years, more money goes through your checking account than is typically owed on a home. So if you owe $500,000, more than $500,000 goes through your checking account in the next 5 years than you owe on your house. So it's a significant amount of money. But the key to it with us that we're going to go into is that money floats in your account for days or weeks and sometimes months on end before it's needed. And so instead of actually using or kind of having that money sit in your account, we're going to help you pay down your principal mortgage on that with those funds. Unfortunately, the money does earn a way low interest rate when it's just sitting in your checking account or even in your savings account. So what we want to do is, instead of the bank using that money, we want to use that money on our mortgage rather than the bank giving it to somebody else to lend out for what they do. So what we do is it's called sweep banking. And the way that we do this is basically, when you get paid, your money goes into your bank. So it's deposited into your bank. And then what happens is that each night that idle money is swept into your mortgage, and we're using that idle money to pay down your principal balance. And you're going, oh, wait, hold on a second. I need access to that money to pay my bills. Hang on. Let me go a little bit further here and kind of get more into the presentation before you get a little scared of this particular loan. So, interest on your loan, on this loan, the all-in-one loan, is simple interest. It's never amortized. So it's not like the 30-year fixed where all of your interest is paid up front. What we do is every night we take the principal balance times the rate and divide it by 365 days for that day's interest. Okay? We do that for the 30 days of the month, 31 or 29 days of the month. And then we add those all up, and that is your interest payment on the 21st of each month. And so what we do is we take that money and we actually use your money and keep down your balance for 21 days, for an additional 20 days. And then we take it out of your mortgage account and actually pay the interest. This is the only payment that you're going to be making, is the interest payment, because you are paying the principal up front. Okay, so we do that every day, and for the next, for every month, we do the same thing over and over and over again. So the idea here is we're lowering your interest payment, means that you can actually pay off and gain more equity by using this sweep banking. We're actually using the money that you're going to use, and we're taking that and paying down your mortgage sooner rather than later. So the deposited money remains available in your account for expenses. So remember what I said before is that your bank, your Visa, or your bank is still going to be your Visa. It's still going to be your personal checks, online banking, mobile banking, client services, all that stuff. You still are doing the same thing on a daily basis. When your bills come due, you're going to write those checks and you're going to move that money from your actually home equity dollars back into your bank to pay those bills. And we do that automatically. You don't have to change anything that you're doing. So as long as you're paying down the principal balance with those dollars that come in from your income each month, the only thing that we're going to have to be worried about here are your personal bills that you have. It is a first lien position home equity line of credit, and we use the daily interest to charge that interest or to incur that interest expense. But what we're doing is we're taking that money out of your checking account, paying down your principal, and then you can actually pay for your personal expenses for that particular month. In fact, we're telling you to wait as long as possible to pay those bills, pay them on time, but the longer you wait to pay them, the more that lower loan balance or principal balance is collecting interest on your loan. So what we do is we give you access to the line of credit for 10 years. So if you got a $640,000 line, you have access to the $640,000 for 10 years. And then after that 10 years, it is reduced each month by 1/240th until the end of the year, or to the end of the 30 years where there's no money available at that point in time. And you can always refinance this loan. It's not a problem. You can get out of it if you want to and go back into a 30-year fixed if you really wanted to. But you still have access to all of these funds. In fact, let me show you how it would work. So let's say that you actually use the principal balance and you pay it down, and then college tuition comes due, you pay those bills and you start to pay it off. You pay it down. You buy, eventually you buy a rental property with it. And then use that as a down payment, and then you pay it off, and then it's paid off for a while. You have medical expenses, and then you pay it off again. It is a very smart way of doing business. So Mike, can you show me how this works versus my 30-year fixed rate mortgage? Yes, I can. We have a simulator that we can take a look at. We can put your information in, give you a really good idea of how this is actually going to work, and see if this is something that is beneficial to you. So we have the simulator, we can work through it. This is an example of that $640,000 loan that we're talking about. And this is paying off in 15.8 years, saving almost $273,000 in interest over that time. But they're paying it off in less than 16 years versus the traditional mortgage, and paying it off in 30 years if you keep it for 30 years. So if you don't keep it for 30 years and you refinance, then you're going to start it all over again and pay more interest on that mortgage. We can save this and share it with you and show down the assumptions and the pay down summaries, just so you feel comfortable with this mortgage. So some of the features of this is, again, basically the QA check. We have somebody actually working with you, confirm your client expectations and answer any common questions that you might have. So we have somebody that actually can do that for you outside of me as the loan officer, if you would like. And then basically you'll get a package within 48 to 72 hours after closing, so that you can set up your account. And then your account, ATM cards, Visa cards, your online, all that stuff will come to you in 2 to 4 weeks after we close. So we do look at, these are some of the underwriting terms here that you might not be familiar with, but basically, we follow the Fannie Mae standards. We do require 10% of reserves of the line amount. So if you had a $500,000 loan, we require $50,000 in reserves. And, basically a 43 debt to income ratio. We use asset depletion for this, and there's no seasoning for the delayed financing. You can use it on non-warrantable condos. But basically the term is a 1 month adjustable and a lifetime cap of 6% over the start rate. We use the 1 year constant maturity treasury, or CMT, which historically has been right around just above 2%. And then margins are based on occupancy and some other items, again, that you would have to talk to me about to kind of figure out where your margin stands. So we use the CMT plus the margin to get to your actual interest. And then just keep in mind that your taxes and insurance, we do not have an impound account on this, because we want you to be able to utilize those funds to pay down your principal, rather than sitting in somebody else's impound account to pay for those things. So at the end of the day, what we have here is a first lien line of credit, and it comes with a checking account that sweeps your money that goes into your checking account to pay down your principal balance, and not changing any of your standards at all. It basically, you work the same way that you work today, and use that checking account to pay for everything. So all we're doing is making it more efficient, using those funds, pay down your mortgage, less interest. And it's basically, we want you to own your house and be able to have that financial independence to do what you want to with your house. And if you want to go buy another house, you can write a check out of this account for the loan. In fact, these loan amounts on an owner-occupied house goes up to $3 million. On an investment property, it goes up to $1 million. So no changes in your lifestyle whatsoever. I really, really love this product and want you to take a look at it as well. So if you have any questions or would like more information on this, please let me know. I'd love to help you out. You can also go to my YouTube channel, Mortgage Wise, and there are a lot of videos on the all-in-one product, maybe some frequently asked questions, along with a couple other videos that might explain this a little bit better. But wanted to thank you for your time. If you have any questions, please let me know. This is Mike Wise, Capstone Direct, powered by CMG Home Loans.